Well, we have a really interesting week here ahead of us because it's Memorial Day weekend, but we also have these Nvidia earnings coming out. Last time I checked, the implied move around the Nvidia earnings was about plus or minus 8.3%. That may have changed over the past hour, though. In any event, it sizes up another week where the most important thing on the calendar is Nvidia. It's not going to be the speech from the Treasury Secretary. It's not going to be anything that Fed Chair Powell says. None of that matters right now for this market. The only thing that matters for this market is what comes out tomorrow afternoon. And I think that sets up Thursday for being really the only trading day of this week, because we're in a bit of a holding pattern right now. You can see it overnight. The NASDAQ, S&P basically giving back what they gained yesterday, the Russell giving back what it gained yesterday. Net this week has been a small change, if anything at all. But I think that's important because for many traders, myself included, you're going into a long holiday weekend, and it may be a week where you're actually taking some time off of work. So the question is, if you're approaching your roll date this Friday, what do you do? Do you wait until the Nvidia earnings come out on Thursday and risk seeing a bit of a drawdown on the position? Or do you simply buy yourself the time right now? So I know what I'm going to be doing. I'm curious about how you guys handle positioning yourselves around binary event risk like an Nvidia earnings report when you have rolls right around the corner and a holiday weekend immediately thereafter.
Okay. So for when you're talking about binary event risk, I assume you're talking about market risk, not Nvidia risk. Okay.
Yeah. So anything, a non-farm payrolls report, right. A speech.
So we don't change. Fundamental rule for us is that we don't change our core positions because of binary event risk, because it's too random, and we're not going to make a judgment call on. I don't know what Nvidia is going to do. Blah, blah, blah. I'm not going to adjust my entire position to do anything to try to offset whatever may happen in Nvidia. I'm a little bit short. I'm going to stay a little bit short, and I'm not going to touch that one bit. What I will adjust, I do have an Nvidia position on, and that one I will essentially, if it's defined, I have some defined risk max loss positions already. I will leave those on. There's nothing I can do. I can only win. The other ones, I have some strangles on, and I have to make a decision on how I want to address those strangles. And I'm thinking that I'm just going to widen out the strikes, but I don't know yet. That's the only decision I have to make tomorrow. I have a wide strangle now, but it's going to be uglier tomorrow.
And I think that highlights the important thing about the market generally, which is where I wanted to bring this explanation. If you look at how binary event risk, if it's a Fed meeting, you look at the big calendar events, earnings reports, those are the days when the market moves. On days without earnings reports or a Fed meeting, the market on average, going back to 1990, has gained 0.03% per day. But when you add in those days that are binary event days, if it's a big earnings report for one of the 10 largest companies in the S&P 500, or if it's a Fed meeting, the market's average return is 0.09%. So that doesn't seem like a lot. You're like, okay, it's 0.09 versus 0.03, but the on average, the return profile of the market on those binary event days is 3 times greater than your average trading day otherwise. So to catch the moves in the market, if you're trading the vol, you can't not be exposed to events like this, because that's when it occurs. And so really the question I have is, I'm going to be looking at my positions thinking Thursday, Friday, I'm off this week. Next week, I'm off. So do I want to just take that risk on Wednesday, or should I just buy myself the time? And quite frankly, time is your friend. You guys know that. You guys dictate that all the time. If you get to your profit target right away, buy yourself more time. Buy yourself more time. So duration is your friend right now. And with the weekend coming up, there could be a vol crush right around the corner. So widening out those strikes was probably the best thing that I heard that you say here, Tom, today. It's the most prudent thing to do. You widen out your strikes, give yourself some time, and vol comes in. You don't really need to worry about the holidays right around the corner. But it is a consideration that people need to make. And it's one that they shouldn't be afraid to make, because these are the days that the markets move, and you have to have skin in the game when the markets are moving.
Yeah, as you know, as people have seen the last couple of days with respect to, I'm just looking at some of these. Silver's come all the way back. It's only down to 12 cents.
I know, it's unbelievable.
Yeah, SLV is actually up on the day. Mm-hmm. But I think that's exactly the way we approach it. I mean, last time I thought I was pretty safe in Nvidia, honestly. I mean, I thought I was way outside expected move. I think the expected move last time was, I want to say it was $50, and I think I was almost $150 away. I was like 3 times expected move, and it moved 100 and something. So it was not a winning trade. In expected move now, Nvidia, what'd you say, $80?
Yeah.
This week? That's a huge expected move. I'm going to be, I'll tell you where I am because I've already widened my strikes out. I'm $200 away on the put side, and I'm $250 away on the call side. That's got to be enough. I'm hoping that's enough.
One thing that happened in February after the last Nvidia earnings was this kind of mechanical adjustment where the market said, okay, we have our new earnings figure. What was the old PE ratio? Let's slap that PE ratio on top of the old earnings figure. That's where we're going to take the share price. Yesterday at market close, Nvidia's PE ratio was 77.5 against a share price of, roughly speaking, $9.24. The trailing 12 months earnings were just over $11. If you swap out the oldest quarter and you put in the new one, assuming they just meet expectations, that's going to bring their trailing 12 months earnings up north of $16 a share, which means if you slap on the same 77.5 multiple, that gives you a share price of $1,274. So if the market sees what it wants to see, just like we saw in February and a little bit more than that, yes, the valuations are high, but I remind everyone the PE ratio for Nvidia at the start of last year was in the 120s. So even though the stock has gone up 5 times since then, the share prices are actually relatively cheaper. So the valuation story here is not one people should pay attention to as a trader this week. It doesn't mean anything, but understand the market can stay stretched. And if people feel like these valuations are still viable, another big ratcheting up, a new plateau can be found in Nvidia very, very quickly, just like the last earnings report. So
you do know that is a very that is the story that's going around everywhere now.
Of course.
And I don't like it.
That if Tom, I'm not saying I agree with it, but that it is something that people believe in, right? And so much of the market, Tom, and this, the critiques of technical analysis, a lot of it's just self-actualizing. If enough people believe in something, it becomes real. And so if enough people believe that the valuations are viable and they just plug that into their calculator, okay, well, then the share should be trading at this. And can a fund manager justify doing it? No. How can you justify doing it right now when everyone and their mother's in the trade? It's a very crowded position, and nevertheless,
that's how every I've read probably 4 or 5 analyst reports on Nvidia, and everybody said they're all making that every single person has a bullish case, and every single person making the exact same bullish case that relative to where it's trading before, it is cheap relative to where it was before. But I hate that argument because Nvidia is the kind of stock like I love when people compare Nvidia to Cisco in 2000. Because look what happened to Cisco. Look what happened to Zoom. Once these runs are over, they're over. Once either there's a disruptor, a new competitor, who knows? Whenever it's over, it's over. And the only way Nvidia stays at the top of the heap, which it is possible that it can, is if it doesn't get out of control. Like the best thing Nvidia should be rooting for is that the stock is unchanged. They should be rooting for that. Because if the stock gets too much juice to the upside, it will become a bad guy. If the stock stays right here, it'll still be a darling. I know, that's my 2 cents.
I think that's a very prudent point. And I want to round out this conversation in Nvidia with where does positioning in the market stand right now? At the start of April, when we spoke on Let Me Explain, I raised the stat about where global CTA positioning was at the time, which at the start of April, we were in the 100th percentile. Traders literally had never been more long before. And that led for a very easy way for the market to decline because who else was left to buy? Coming into this week, we're in the 93rd percentile for global CTA positioning for net longs. It's not as long as it was, but it's still pretty long in the darn tooth. And so if Nvidia gives anyone an excuse to start deleveraging here, as we just cleared out new all-time highs, you have a holiday weekend coming up. Thursday could be slippery. It could be ugly. I personally think that if you're intent on staying with your longer term, longer duration equity positions, simple thing maybe to do is look at maybe a cheap downside put in the triple Qs, something that's related to maybe even SMH. I know it's less liquid, it's an ETF. We don't like to do that, but find some way to protect yourself this week because this is a very crowded market. And any excuse 2-3% down day on Thursday, why wouldn't want people take their chips and go home when we have a barbecue weekend coming up right around the corner?
I think that, I wouldn't buy a put, but I think if you want to sell an out of the money call spread or something like that, I think that's a prudent play. And I just think there's a lot more risk. Look, we haven't had a down move in I don't know, a month, and we have volatility at all-time lows. I mean, if you're going to play the pot odds here and you're going to protect yourself, like what cracks me up is that people buy protection at the worst time, and at the best time they avoid protection like it's like it's the plague. Like if you ever wanted to
no
do
one buys
something,
flood insurance when it's sunny. Right.
I mean, if you ever wanted to do something, just to not really, I don't even call it a hedge, but if you ever just wanted to take a decent shot, now would be a decent shot, I think.
Yeah.
That's all.
Yeah, that's my mindset as well here. That's my mindset as well. Tom, I know that you're not really interested in talking about the yen here today because while you and I trade it, it's not the most highly traded thing. So we can table that for another time. I know Ilya will want to talk about that later.
I mean, the yen is it's having a tiny, tiny little itsy bitsy bounce today. And it's been a PIG pig.
It has been a pig, and that's one of the reasons why I find this idea when you look at the options pricing right now. If you want to sell, puts or put spread beneath the lows that we saw last month, effectively right above where the dollar yen spot rate of 1990 is 160.40, you're not really being compensated for it right now.
No.
And the market has the sense that this thing is it's a red line in the sand. No one's going to cross it. I would point out, and again, I brought this up before, but 1992, I think it's worth just a quick explanation of what happened. 1979, all these countries in Europe agree to stop war. We're going to evolve beyond the European coal and steel community. We're all going to have the same currency one day. And so they set up this thing called the exchange rate mechanism. And the goal there was for all the currencies in Europe that wanted to join the euro to trade within a 2% band around the German Deutschmark. And in 1990, Margaret Thatcher says, hey, the UK should join the ERM as well. And so the British pound is put into the ERM, trading at the level of 295 relative to the German Deutschmark. And this hurts the UK. It crushes UK exports. They're not competitive. And so the market, led by George Soros, among others, tries to sell the pound. And the Bank of England is forced to burn through their FX reserves to prop up their currency. Eventually, they run out of FX reserves. And what happens? The pound crashes. George Soros makes his $1 billion. The quantum fund becomes famous. Druckenmiller gets his start, yada, yada, yada. It's a similar position to where the yen is today. The fundamental headwinds exist. Oil prices are staying elevated, even if I'm bearish. We're seeing that yields, while they've come in, the interest rate differentials aren't moving far enough. The BOJ Ministry of Finance have probably spent around $75 billion equivalent worth of the reserves so far, which seems like a drop in the bucket, but they only have $1.3 trillion worth of reserves. So the longer this problem persists and the more reserves get burned down, the greater the likelihood that we see a big implosion in the yen. It's been bad so far, but it may not be over yet. And so I just caution people, if you're seeing that, okay, well, 160.40 held in the dollar yen spot rate, and I can pick up some easy free money here by selling puts on the other side of that, equivalent in 6J, I don't know if that's the play right now. It's picking up pennies in front of the proverbial steamroller. It's a high level of risk, and we're heading into illiquid markets. That's when the BOJ and Ministry of Finance like to do things. So just be careful this weekend if you're trying to get long the yen.
Well, I'm already long it, so I'm not trying. It's
He's failing.
yeah. It's definitely not a challenge.
Anyway, that's an interesting take. I think at these levels, I love the risk reward in there. But again, it's a crappy little play. Nothing special. But I love the risk reward. All right, what else you got, Pat?
That's it, my friend. Are you good?
What else you got, Chris? Any subject you want? You covered Nvidia. You got the yen in a little bit. You talked about getting closer to a holiday week, but holiday weekend. I'm sorry.
Well, I guess we're a week removed from it now. Is Meme Stock 2 Electric Boogaloo officially done?
I mean, yeah. Tony?
Yes. Be my guess.
The management team has approached this very differently this time. There's two sides of this, right? The management team saw the share prices go up and they immediately dumped shares onto the market to convert debt to equity. Smart thing to do. And that nipped it in the bud. And also the way that the options market was structured this time, dealers had different ways to hedge their bets. But this thing was a nice, I guess, 1 week narrative. This was not a gamma squeeze. This was not the end of the world short squeeze, the mother of all short squeezes, right? This was just, it looks like a pump and dump, unfortunately. And who knows if Roaring Kitty is actually Keith Gill on Twitter. But
I don't know, but
good time to stay away.
It clearly looks to me like some of the big high frequency firms got way out in front of this, and they might have choked on a little bit of longs, actually. I don't blame them if they did, because I think that was the play they had. They had to be long stock. They have to keep inventory. It's funny. Somebody wrote, some reporter.
Still crazy implied volatility in the out of money.
Yeah, they're still crazy. So some reporter wrote me yesterday and said, or called me and said, she was writing a story on the whole GameStop thing, and she said there's been a lot of rumors that there was a huge option buying. There's a lot of unusual option activity in the week before this whole thing broke. In the week, 2 weeks before. So she said, "What do you think?" Because a lot of people have given her quotes about unusual option activity and all this kind of stuff in GameStop. So I said, well, if you want my opinion, I go, because I like to look at things quantitatively, I said, I would bet you that if we go back and we look at GameStop since 2021, there has been a lot of option activity every 3 months.
There's been so-called unusual option.
Yeah, there's been unusual option activity, but nothing happened. See, the thing with unusual activity is that everybody goes, oh my God, look at this, all this call buying that took place. They're buying the 30 calls.
It's not unusual until it works, but it works every 10
but
times.
nobody writes about all the times that it fails, which is about 95, 98% of the time. So she said, can you prove that? So I go, okay, sure. So I went back and asked our data scientists to look up all the activity in GameStop since 2021. And it turns out there were 14 cases, 14 different instances that were almost exactly the same as this one, where there was unusual option activity, buying out of the money calls, in fact, the unusual activity exceeded one standard deviation, or 84% of the time. It exceeded all the activity in that range. That's how we determined what exceeds it. Mm-hmm. So it was in the top. It was in the top, 16% of all the activity. We considered that to be it. And there were 14 times since 2021, and this is the first time that there was any follow through. So I said to her, I gave her all the data and said, "See, there's 14 times. So basically, we're talking about a 6 or 7% chance of this happening, and it hit." One time. But I go, you're forgetting that the past 14 times everybody got wiped out. So nobody that's been doing this actually made any money. They got even on the 15th time if they held it, which is almost impossible to do. Because after you've lost for 14 straight times, you're not that excited about doing it on the 15th time. Anyway, that's my point. So everybody that goes, oh my God, look at all these people that were buying calls because they knew it was happening. No, they didn't. They've been doing it for 15 straight times. They've lost money 14 straight times. The 15th time it worked this time, which they got lucky. And they had 2 days to take profits.